As Asia continues to emerge as a key player in the global carbon markets, understanding the future of compliance markets will help determine how this region will play a role in global climate action, right? So what is your perspective on the future of compliance carbon markets, particularly emission trading systems in Asia?
Yeah, thank you very much, Rita, and thank you for the opportunity to join this webinar. So in response to this question, I would say that number one, it's the compliance carbon markets are going to become more important. The reason for that is that NDCs are becoming tighter, and then that will require more cost-effective policies to comply with the NDC. So emissions trading systems are inherently cost-effective because they encourage emissions to be reduced where they're cheapest. There's a wide range of options available to entities on how to reduce their emissions, and it encourages innovation and creativity. And the second element is the second key driver is the expansion of CBAMs. So carbon border adjustment mechanisms will expand, and also the CBAM charges are likely to increase as the carbon prices in those jurisdictions increases. So emissions trading systems also reduce the cost impacts of CBAMs. So firstly, by any carbon cost paid in the jurisdiction in India, for example, will be deducted from a CBAM charge. And then also secondly, the ETSs will drive reductions in carbon intensity production to reduce the exposure to CBAMs. So looking at Asia then, so Asia is a real hotbed for ETS development. And probably two elements to highlight. Number one is the further establishment of emissions trading systems in Asia. The Indian carbon credit trading scheme is perhaps the most exciting and significant new development of emissions trading systems, the compliance mechanism in Asia. And we're going to hear more about that during this webinar. Also, Vietnam is looking to introduce an emissions trading system potentially next year. Also, systems under implementation already will be expanding. Dirk mentioned the Chinese system. China's national ETS already covers over 5 billion tons of GHG emissions. The expansion expected to be confirmed this year to include iron and steel, cement and aluminium will expand its coverage to about 8 billion tons. It's a huge system. Indonesia's system is already operational for grid-connected power plants, but it will expand to captive power plants, industrial sectors. System in Japan is a voluntary system that will move to a mandatory system by 2026. And then the other aspect is the improvement in the design. So one of the key features of the ETSs in Asia so far is the relatively low carbon prices and the limited amount of climate finance being generated. So what we're likely to see is the cap setting will gradually improve and become tighter. There'll be more clear links to NDCs. So Korea already has a clear link to its NDC. And there'll be a shift towards absolute caps from intensity. So China is likely to move to an absolute cap potentially by 2030. In terms of the allocation, we expect to see tighter benchmarks. So there's a feature of ETSs is perhaps surplus allowances in circulation, reducing the price. Tighter benchmarks will also reduce exposure to CBAM because free allocation does not protect against CBAM charges. So we expect, for example, in the Korea ETS in phase 4, the benchmarks will be based on top 10% performance. There'll be an increase in auctioning. There'll be introduction and scale up of auctioning driven by the desire to generate finance and revenue to support investment in industrial decarbonisation, just energy transition, etc. The climate finance I mentioned there is going to be an important aspect of ETS development in Asia. It's increasingly been seen as a central element in combination with the impact of the carbon price. So, for example, this year we saw that Japan launched the Japan Climate Transition Bond, which will raise $120 billion of money for supporting green transformation in Japan to leverage about over $900 billion of public and private sector investment. So there'll be a lot of development of climate finance and also the carbon market itself. One of the features of ETSs in Asia is limited liquidity and also price control needs improving in some areas. So there'll be more introduction of third-party participants and then more market stability measures. We expect to see, just finally, that the sectors will be established to be mainly the energy-intensive industries and the power plants, but also buildings and transport are likely to be included as well. So for Korea, for example, is considering that, following the ETS2 in Europe and other systems. So definitely a lot of development and improvement planned, and huge potential for ETSs in Asia.
Wonderful. I think that gives a very good overview of what's happening in Asia, and clearly there's a lot of things that are emerging in the different national markets. Since you are so closely associated with, and you're working with BE on the CCTS as well, how do you see the CCTS contributing to the achievement of India's NDC targets? What are your thoughts on this?
Yeah, no, thank you for the question. And I think Mr. Sorabdidi has explained quite a lot around this already, and so I don't want to repeat what's already been expressed. But as stated, the CCTS is a key policy to help India achieve its NDC targets. So it's selected because it's cost effective and it's well demonstrated internationally. So if you look at perhaps two parts of this, there's the obligated entities and then the non-obligated entities. So the obligated entities represent the main energy intensive industry sectors currently. So that's aluminium, cement, chlor-alkali, fertilizer, iron and steel, pulp and paper, textiles, petrochemical, petroleum refineries. So there's a huge number of significant industry sectors covered, the 9 sectors Mr. Diddy mentioned. So the target setting will take into account the India's NDC, and as the NDC evolves, so the NDC for 2035 targets will also be reflected in the CCTS future targets. The targets will gradually get tighter as India transitions to net zero. So companies will respond to these targets, and they will be incentivized to be creative, and they will be incentivized to look hard across their whole business about where are the emission reduction opportunities. So clearly India has been operating under the PAT scheme for over 10 years. So energy efficiency is well understood, and probably a lot of good practice around energy efficiency is already in place. But the CCTS opens the door for fuel switching opportunities, for more renewable energy, recycling of waste gas and heat, process changes, abatement technologies. So the value of the allowance and the credits will drive this incentive, and companies should be developing their own marginal abatement cost curves to work out what is the most effective strategy for themselves. So the mechanism will work through the operation of the monitoring, reporting, verification system, and then there's the sanctions that will be imposed for entities that do not comply. And what we see globally is that there's a very, very high level of compliance with these systems because the sanctions are set to dissuade organizations for not complying. And then looking to the future, we can see that as the targets will get tighter, that the needs for the corporate sector for financial support will probably increase as they need to implement deep decarbonisation technologies that are not yet commercially available. So there is an opportunity for the government to use the CCTS as a source of climate finance through potentially auctioning allowances to certain sectors and set up a fund similar to the EU's Innovation Fund, which has successfully supported a number of major energy intensive industry sectors in significant decarbonisation projects like green hydrogen steelmaking in Sweden by 2029, petrochemical plant, CCUS projects, etc. And then also in future, we expect there'll be more focus on the target setting methodology so that as the targets get tighter, India will look at what's the right methodology and what's the right approach to balance the targets across the whole economy. So the EU has a burden sharing approach between ETS and non-ETS sectors, and each jurisdiction will have to carefully consider what's the most economically viable and optimal solution. So there'll be more work, I think, in the future around that, as Mr. Diddy intimated. And then the other side of this is the non-obligated entities. They have the opportunity to participate in the offset mechanism. So this incentivizes these project-based emission reductions in technologies that are strategically important to promote. So green hydrogen, ammonia, renewable energy with storage, offshore wind, etc. So I think it's going to play a central role in helping India achieve its NDC targets.
Wonderful. And I think the fact that it can, the opportunity for climate finance through the CCTS, as you mentioned, I think that's an important one to also harness, right? What do you see what kind of preparedness do the market participants need to work on from now on to participate effectively?
Yeah, I would say there's probably three main areas for corporates to work on. So number one is to ensure that they have in place a suitable carbon management team across their company with clear roles and responsibilities for implementation of the CCTS compliance strategy. Number two, develop and implement a monitoring plan to monitor GHG emissions and GHG emissions intensity in line with a detailed procedure for the compliance mechanism under the CCTS, which Mr. Didi mentioned. And then number three is to identify and implement emission reduction measures across the company. So that would include firstly, developing the objectives that the company has, gathering the detailed data on the abatement potential and cost of different measures, developing a marginal abatement cost curve, expressing the measures in terms of cost effectiveness against abatement potential, and then identifying a short-term low-cost solutions. For example, this could be measures less than, say, $10 per ton abatement that could be implemented quickly, and also meet other corporate financial metrics. Then they could be no-brainers to go ahead with quickly, and then also identify medium and long-term technologies. So then they'll build up a strategy, and then a roadmap, action plan, and then implement, track progress, and revise as necessary. That's what I would say.